We'll talk about whatever they'd like to talk about, and for as long as they want to talk. And so any subject they want to get into, except what I'm buying currently, I love to talk about what they want to talk about.
Is it common to be asked for stock picks in these lunches?
No, actually it isn't. In fact, I can't recall ever being asked. But we talk about family. Actually, the couple that bought it this year are bringing along 2 small children, and we talk about the children raising kids. A lot of things. It's not all stock or business or finance at all.
Well, let me be the skunk at the garden party and start asking you about some of those things. You are joining us on a day when we have watched the stock market continue to set new highs. The S&P, the Russell, and the NASDAQ. The Dow's not far off. And the question we always ask you is, do stocks look expensive to you at these prices?
Well, they are definitely. If you had your choice between buying and holding a 30-year bond for 30 years or holding a basket of American stocks, there's just no question you're going to do better holding stocks. So it's more attractive considerably more attractive than fixed income securities. That doesn't mean they're going to go up or down tomorrow or next week or next year, but over time, a bunch of businesses that are earning high returns on capital are going to beat a bond that's fixed at roughly 3% for 30 years. And it's not my field of specialty, but actually they look stocks generally, which are their businesses, they're American businesses, 30 trillion worth of them, and they look cheaper than generally real estate.
Is that the only thing that makes stocks look attractive right now, is the comparison with fixed income?
Well, that's what you have to do in investing. I mean, you're sitting with some cash in your pocket, you've had savings, and the question is, what do you do with it? You can buy a duplex next door and rent it out to people and do fine over time, or you can buy a small piece of farmland or something of the sort, or you can put it into something fixed income, bonds or bank deposits or whatever it may be. And stocks, if you look at American equities, American business is earning a lot of money relative to the capital put in. And the reason stocks are worth a whole lot more than they were 20 years ago or 50 years ago or 100 years ago is companies have plowed back part of the earnings. With a bond, you get it all out in interest. You know, you get your 3% or whatever it is, and that's what you have. With stocks, you get maybe a 3% dividend, but they're plowing money back, or they're repurchasing shares or doing something. And over time, that just makes a huge difference.
The reason I ask about stocks sitting at these new highs and whether you think the market's expensive is because there are retail investors who are sitting at home, and when nightly news starts talking about how the markets are at new highs, some of those retail investors who have been sitting on the sidelines think, oh my gosh, I missed my opportunity again. The last time we talked to you, you said you were still buying stocks. Are you still right now?
We're buying stocks this morning, and I'd rather buy them cheaper, but I've been buying stocks since March 11th, 1942. And I bought them under every president, 7 Republicans, 7 Democrats. I've bought them quarter after quarter. Some of the buys were terrific. Some of them were at such good times. And I don't know when to buy stocks, but I know whether to buy stocks. And assuming you're going to hold them, wouldn't you rather own an interest in a variety of great businesses than have a piece of paper that's going to pay you 3% in 30 years, or a short-term deposit that pays you maybe 2% or something of the sort?
Yeah, no argument. Although your concentration in the stocks you own has gotten a little more concentrated recently. There was a filing that came out not too long ago that showed Berkshire Hathaway was continuing to buy shares of Apple. That stock is also at a new all-time high last night. It's now, you own 5% of the shares outstanding of Apple. It's the biggest holding for Berkshire Hathaway at $56 billion. Have you continued to buy even since that filing?
We bought just a little. About 6 million of the shares are attributable to another fellow in the office that's owned it for a considerable period of time. The rest are my portfolio. But I bought just a little bit. I like to buy them cheaper. I mean, it's very difficult. I started buying when the stock was maybe 100. And I was buying it kind of as fast as I could, and then I ended up buying some as high, a whole lot higher. I won't name the exact price, but a whole lot higher. I'd rather have it go down. For one thing, if it goes down, Apple's going to buy a lot of stock back. They're already buying stock back. And if it goes down 10%, it means they get to buy 10% more shares, and my interest will go up 10% more for spending that money and buying shares. So I am benefited by going down. If I were to talk my book, I would talk it down.
I spoke with an analyst today, Gene Munster, and he pointed out that the interesting thing about Apple is that for a long time it was a very volatile stock. It kind of traded in this boom and bust cycle. Every time they had a new phone that came out, it would push the stock higher. If they didn't have a new release, it would drop. He said that it's still 65% of the business, but a lot of people are maybe looking at it a little differently. And he wonders how you look at it. Is this a boom and bust cycle, or is there something different?
Not in the least. I don't, I like to see the new release do well, or, that, but I do not focus on the sales in the next quarter or the next year. I focus on they won't tell you exactly how many, but hundreds and hundreds and hundreds of millions of people who practically live their lives by it. And if you look at that little piece of whatever it is, that is some of the most valuable real estate in the world. I mean, that is, Fifth Avenue will never come close to that. I mean, it is, you've got hundreds and hundreds of millions of people with loads of buying power and able to do business or learn information or whatever it may be, and it's part of their habit of living. I mean, they spend hours a day, and it does all kinds of things for them. So that real estate is worth a fortune, and it's nice to have it added to as they sell new phones, and of course a lot of them are replacement phones. But they're adding to hundreds and hundreds of millions of consumers that are never going to get to Fifth Avenue, or they're never, and you are an indispensable part of their lives. I mean, it's an extraordinary product.
So you don't even look at it like a tech analyst would, or like a tech company for that matter?
I look at iPad. Oh, you mean
just in terms of how you value this stock?
Oh, in terms,
consumer products.
They've got to keep having the product that there's huge clientele regards as indispensable. So it's got to be the best thing that they can tell us to when airplanes will arrive, or whatever it may be, what the weather will be, what stocks are doing, a million play games, whatever it may be, and that's important that their replacement products are looked at as super desirable. But one of the things that I grew to understand was we have a very large retailing operation, the Nebraska Furniture Mart, and if people went in to buy the latest iPhone or whatever it might be, if for some reason we didn't have it, you couldn't sell them anything else. They either went next door, which we didn't want them to do, or they came back. But I mean, it wasn't an alternative. And when you have a product that is that personal, that valuable, and they talked about the iPhone 10 costing $1,000, and that a lot of money. I have a plane that costs me a lot, maybe $1 million a year or something of the sort. If I used the iPhone, I use an iPad a lot. If I use the iPhone like all my friends do, I would rather give up the plane, which is $1 million or $1.5 million a year, for something that costs $1,000. I mean, the iPhone is enormously underpriced. Now it's got competition, so you can't push the price. But in terms of its utility to people and what they get for $1,000 someplace else, you're going to have a dinner party that costs that. And here this is, and what it does for you, it's incredible.
You mentioned airplanes and airlines, and I just wonder, are the airline stocks that you also still find attractive? Have you been adding to your positions there?
Well, we can't add. I mean, technically we could, but I don't want to go above 10%, except in rare circumstances of the security. So we own 9.5% of the four largest, and I actually have to trim them just a little if they're repurchasing shares to stay under 10%. If I could buy 20%, I would have been happy to buy 20%. But so we've got about what we can handle.
Warren, let me ask you a little bit about the news of the day. Campbell's came out with its own business initiatives, its strategic initiative today.
I saw that.
You saw that they're selling off a couple of units, the fresh foods and the international. Does that make it more attractive or less attractive as a buying opportunity for something that could get wrapped in potentially to Kraft Heinz?
Well, I don't know that it changes the picture a lot. I mean, presumably they're going to get fair value for that. So if they would be calculated by any acquirer as being worth X. Now it may or may not be tax efficient. I don't know the tax basis on those assets, but if they have a low tax basis on those assets, then it actually decreases value a little bit for another buyer because you've given some of it to the government in the process. But I don't think in terms of any other company looking at it for acquisition, they are probably selling the assets that those companies would have been particularly looking for. But I don't know Campbell that well.
You saying you don't know it that well makes me think that you haven't been looking it over, considering it as a purchase, because Dan Loeb would like to see somebody buy it. And my question is, would Berkshire be interested? Would Kraft Heinz be interested?
Well, Berkshire certainly wouldn't be. But that's partly because we own Kraft Heinz too. We wouldn't do any. But I think it's very hard to offer a significant premium for a packaged goods company and have it make financial sense. The packaged good business makes high returns on tangible assets that it has, but it is a tougher business than it was 10 years ago, and the stocks are higher than they were 10 years ago. So back in the 80s, we were the largest shareholder of General Foods. I've always liked brands, and they're very good brands, but in terms of the battle of the retailers versus the brands and the willingness of people to change their habits, probably had a higher propensity for that than 20 or 30 years ago. So branded packaged goods are a very, very, very good business in terms of return on tangible assets, but they're not a sensational business in terms of where you can be 5 or 10 years from now.
Let me ask you about some news that Berkshire made a little over a month ago. I'm not sure it received quite the attention that it should have. You said that you were changing your views on buying back Berkshire shares.
Right.
For a long time, you've said that if it got above 120% of book value, you would buy it back. That created a floor for the stock. Now you say that you're throwing that out the window. Right. If you and Charlie look at it, and you and Charlie Munger and agree on it and think it's worth it, you'll buy back stock. Have you bought back any stock since then?
We've bought back a little, yeah. And we tie it now to intrinsic business value, which we should have done all along, but for a while, book value was a good proxy for, it didn't fully describe intrinsic value, but it tracked it. And it was a reasonable proxy. And it's gotten to have less and less importance as we move to operating businesses from investments. So what really counts is what are the businesses worth, along with the securities we own. And if it's at a discount to that figure, Charlie and I will buy, and we bought some.
How often do you and Charlie talk about it?
Well, we don't have to talk very often because if it's so close we have to talk every time it moves 1%, it isn't worth buying. I mean, so there should be a margin of error in our calculation. So we never talk day to day or week to week on it. But I know that what's in his mind, I know what's in my mind. We're totally in sync, and we need a big enough discount so we're buying it at what we know is a price where the continuing shareholders are going to be better off because we bought it. We're running business for the people who are going to stay, not the ones who are going to leave.
About a week and a half ago, or just about a week ago, I spoke with Brian Cornell. He's the CEO at Target, and he said that in his career, he's never seen a better environment for the consumer, that things seem to be firing on all cylinders. I just wonder what you see when it comes to the economy, what you see when it comes to the consumer.
Well, the economy, really since the fall of 2009, has progressively gotten better. But it started from a very low base. It started from panic. And we've now had very soon, we've had 9 full years of improvement in business. I mean, quarter by quarter. Now, sometimes it looks like 1% or 1.25%. Sometimes it's 2.5%. Now it looks even better than that. But business is good. Across the board, business is good. It was good 2 years ago, but it keeps getting better. But the American public household wealth is over $100 trillion. And 250 years ago, this island where nothing was worth, there wasn't anything here. I mean, $24 for Peter Minuet.
But the economy's firing on all cylinders. One issue that people have worried about is what's happening with trade and tariffs. Have you seen any impact on Berkshire's businesses or higher costs associated with any tariffs that have gone into place?
Yeah, there are a few, definitely. And we buy steel, for example. I mean, at MyTech, or we buy it at a lot of places. And we are seeing some effects from that, and we're seeing some effects from inflation.
I'm sorry, from inflation.
We've seen more in the way of cost increases in the last year, if you go across all of our businesses, but particularly building materials, or we sell paint. I mean, the can it comes in, that is a lot more expensive than it was a year ago.
How much of the inflation is directly tied to the tariffs, and how much is just from an improving economy and inflation you would expect to creep in?
I can't tell you exactly yet, and some of them are kicking. Well, newsprint, it pops up in different places. I haven't really done that, but I was seeing it in raw materials well before the tariff situation came up. But the tariff situation will aggravate it significantly.
Well, let's just talk about that. If you are seeing price increases coming through, that may lead you to the conclusion that you think the Fed should raise rates or continue to raise rates as they've been doing. The president, Donald Trump, tweeted out and talked in an interview about how he doesn't like to see the Fed raising rates. What do you think about that? Just as somebody who watches it.
I think Jay Powell is a terrific chairman of the Fed. I've not known him well, but I've known him. I know people he worked with, and I've listened to what he's had to say. So I love the fact Jay Powell is chairman of the Fed, and he will do the right thing. As he gets a lot more figures in than I do. I may get him a little faster on some things than the Fed. They may work their way through, but he will see it, and he'll do what, in his judgment, is best for the American economy over time. There's no question about that, and maybe he'll make mistakes. I know I'll make mistakes, but he knows what his job is, and he'll do it.
The president also tweeted about another initiative, and I just wondered what you thought about it. He said that after speaking with Indra Nooyi, we later found out that she was the one who had talked to him, that he would like to do something that he thinks will help American business. That's to say, stop reporting every quarter, maybe do it on a 6-month basis. What do you think of that idea? Because you have focused on long-termism.
Yeah. Jamie Dimon and I came out a while back, but I've always focused on the idea that, I like to read quarterly report. I was an investor, and we've got a couple $100 billion worth of common stock. So I like to get those quarterly reports. I do not like guidance, and I think that guidance leads to lots of bad things, and I've seen it lead to lots of bad things. I don't think quarterly reporting itself, it's when you get into promising people what you're going to do every quarter, because I can't promise it what's going to happen. We're in the hurricane season now, and you can change our earnings dramatically with a storm or something of the sort. So I think it's a very bad practice to be in the game of earnings guidance, and it is a game. I mean, people play it as a game, and then people adjust to numbers and all that. But I like to get the figures quarterly, and I hope that stays.
I don't know if you follow Twitter very closely. My expectation is that you don't.
Yeah, you're right about that.
But there was a fake Twitter account, a fake Warren Buffett Twitter account that went from 20,000 followers to 200,000 followers in 24 hours by tweeting out all kinds of pithy sort of sound advice, things that said, folksy sayings that sounded like they could have come from you. Why don't you tweet more often?
Well, I just don't see any reason to. I put out an annual report, and I do not have a daily view on all kinds of things. And maybe I've got a guy in this copycat or imitator. Maybe he's putting out better stuff than I would. So if he puts out enough good advice, I'll take credit for it.
We have seen some CEOs who like to tweet very frequently, including Elon Musk.
Yeah.
He's certainly somebody who's tweeted a lot. What do you think about people who do tweet a lot?
I don't think it's helped him a lot. No, I think it'd be particularly dangerous to start commenting on Berkshire daily, which I never would do. I won't do it with you. But no, I just think there's other things in life I want to do than tweet. I mean, I'm not that desperate for somebody to hear my opinion on this.
Warren, it's your birthday today, your 88th birthday, and we want to wish you a happy 88th birthday.
Thank you.
In fact, we have something that we've ordered up. the chefs here at Smith & Walensky put together just to celebrate your 88th birthday. This year, they went out of their way to focus on the Coke holdings. It's your 5th largest holding, so there's your happy birthday cake.
Wow, that is terrific.
I just wanted to talk to you about, at 88, there's probably not a lot of new tricks that you can get taught. But I know that even though you don't have a smartphone, you do have an iPad.
I have an iPad. I use it a lot.
What do you do with it?
Well, I keep it around on my desk during the day, and if I want to check anything in the financial markets, that's an very easy way to do it. But I look up things. I mean, it's what I do with a computer at home, and a computer's enormously useful to me. And the iPad is the one I have in the office, in effect.
Do you ever listen to any podcasts? Do you ever follow anybody else? What other kinds of things do you do with this?
I listen to a podcast from my friend Tom Murphy the other day, but podcasts are normally, they take a while. I can read faster than I can listen to one, but I recommend that. It was done with David Novak. It's a 28-minute podcast. And anytime you get to listen to Tom Murphy, I think it's terrific. But generally, I don't because of the time element.
And what did you learn from Tom Murphy in that podcast?
Well, I've been learning from him ever since I met him in 1968 or 9. I mean, the very first time I met him, I learned. And Tom Murphy, like Charlie Munger, has made me a better person than I would otherwise be. I mean, that's the ultimate gift you can give to somebody, and Tom